back. You're watching Stock Watch with me, Zinati Kuma, and joining me to unpack your stock-related questions tonight are Grant Nader from Benguela Global Fund Managers and Jared Houston from All Weather Capital. Please be sure to send your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Not to worry, the laptop isn't here, and don't worry, we didn't have a cyber attack like Nampak, but I do have my phone, so I will be getting the viewers' questions when they do come through, and maybe someone can take pity on me and get me a fancier phone. Thank you so much for your time, gents. Let's actually start off. It's been a very interesting week of gains. The JSE, they're having a 4-day winning streak, which is something I don't think we've seen in a while. Jared, just starting with you, what have you made of the gains that the JSE has gotten this week, and if they're sustainable?
I think it's certainly encouraging to see the positive trajectory of the JSE. I think us long-suffering local investment managers have had to suffer through quite a difficult period, so encouraging it is moving in the right direction. I think whether it's sustainable or not, certainly in the short term, largely depends on some of the sentiment around the political outcome. Of late, news around the polls and the level of support for the ANC and what that means for coalition politics has dominated the narrative. And of late, a more positive spin on the potential outcome and what that looks like has led to strengthening of the rand. We've seen our bond yields come back, and that supported ratings of the local shares. We've seen that support coupled with positive commodity prices, and then China pulling up higher, dragging Naspers prices higher has also been positive. So, the starting level of valuations for South Africa is quite low. So we certainly think there's more to go from this level.
Yeah, more to go, Grant, even on the China side, because we did get that trade data for April, actually really coming out positive. So can we just expect, better growth coming out of China, and obviously that filtering through to the local markets?
Yeah, so we've been expecting China to stabilize. The last couple of months of PMIs and the like have been positive. There are good signs coming out of there, and more importantly for the likes of Tencent, they're not really affected by the PMIs, but they are certainly affected by the regulatory intervention and the government's game approvals and things like that, and that's been positive. They're stepping back from the interference, and that's allowing these companies to drive earnings again. I think Tencent still remains cheap. It still remains an interesting opportunity, and that feeds through into Naspers process, which have been doing very well of late, as has the broader China index. So I think there's more legs there, and I think into the election, if the market runs a bit much further, you're going to find some profit taking as maybe there's some jitters closer to the time. But certainly, I like the setup here, and I like the risk reward given the valuations that we're coming from.
Well, talking about running, of course, those U.S. markets have had quite a run. S&P 500. There's a question here on that just came through on the S&P 500 ETF. I just want to know which S&P 500 ETF is the better one to invest in, the Satrix S&P or the Vanguard S&P 500. The Vanguard in dollar terms seems so expensive to just even own one unit. I'm currently investing in the Satrix S&P. Am I okay there? Jared, do you think that there is a better one? Would you even be investing in an S&P 500 ETF at the moment?
I think you mean on the question of which is the better relative ETF. I'm not that familiar with the two details of the two, but I would generally just have a look at what more closely tracks the index between the two, where the differences are, and then obviously the level of fees and other costs associated within the product are important to monitor for investors. Whether the S&P index itself is a good investment at this level is another debate. Clearly the US market has been particularly strong over the course of last year, particularly the tech sector and the Magnificent Seven driving that market significantly higher. So the valuation gap between the US and the rest of the world is probably as wide as it's been, with emerging markets out of favor. So I think certainly relative valuation favors emerging markets at this stage in the cycle, but there have been some strong trends. AI in particular has driven the tech names higher. We've got to see if that's sustainable or not, and whether the valuations at this point are pricing in the growth is yet to be seen.
Yeah. Grant, where are you on that debate of whether to invest in the S&P 500 at this point? And if you would be, which do you think would be better, Satrix or the Vanguard?
Uh, I think, look, when it comes to differentiating between ETFs, they should basically do the same thing,
Yeah.
and the cost differential is the biggest thing. Unless there's like they use quantitative replicative sampling and things like that to save costs, etc. So your main differentiator will be costs between them. I think you can just look at that and make a call. I think both will be perfectly fine. In terms of whether I would invest in the S&P, if you're asking me on a long-term basis, if you're saving with a planned 10, 15, 20-year horizon, absolutely, the valuation won't matter as much. Is it good value today? It is looking quite rich. It's had a good run. There's definitely other value to be found out there, but then you don't get the level of innovation and kind of growth that you're getting in the US currently. That US economy is an incredible ecosystem at the moment. So you're going to give that up in return. That's why you're seeing the premium valuations as well, among many other things. So I would have it. It wouldn't be the only thing I own in a portfolio, but I would certainly think with a long-term hat, just you can't go wrong owning the S&P.
All right. Well, you talk about premium valuations. Let's go to something on the other side of the spectrum. Murray and Roberts. Murray and Roberts seems to have broken the 1 Rand 50 resistance level. If it holds above this level, would you consider it a buy for a medium-term hold? Very, very cheap. But Jared, cheap for a reason, right?
I'm not that familiar with the fundamental investment case of Murray's at the moment, so I'm not in a position to recommend buying it or not. What I would say, just looking at the domestic construction sector, it has been through a tough time of the last, all the way going back to 2010 and the post kind of World Cup spend boom. It has been a difficult time for construction. We've seen a number of players go out of the market, a lack of new projects being taken, and significant margin compression across the space. So after a very tough period, for the first time in a while, we're seeing projects come through, whether it's Sanral on the road side, whether it's renewables and bank lending. We're seeing that start to come through. Yes, it is early days and follow through, and actual spade in the ground work needs to come through to see proper evidence of that. But for the first time in a long time, it looks slightly more positive for the domestic stuff. So I would say, that is a space that's starting to look a bit better, but the specifics of Murray's, I wouldn't be able to comment on.
Buying Murray and Roberts. Grant, I do know that they are a leaner business, but are they meaner?
Well, this is a tough one. It's a really become a micro cap. They're not profitable at the moment. They have quite a diverse geography, but it's a tough industry. There's prospective improvement coming in construction. I agree the government's going to, they've been saying it for a long time, but there are signs of real spend that's happening. But I wouldn't call this fundamentally a great buy. I think you need to be very clear that this is quite a speculative small cap potential value trap. And take it from that point of view, and then if you want to buy some, sure, it's not a stock I would own. I don't see much quality there. I don't see any sustainability of cash flows. I don't even know if the business is sustainable. So just be clear, don't overcommit to it, and perhaps if you're speculative, you can have a nibble, but that's about it, I would say.
Yeah, all right. Well, another company that some investors see as a value trap is Sasol. There's a question here: Sasol, a buy or a sell at the moment? Jared, where would you be on that debate?
I think it's a very widely debated stock at the moment, with some strong views on both sides of the argument. For me, certainly Sasol looks cheap at the moment. If you look at what the earnings and the cash flow generation based on spot oil and chemical prices and where margins are at the moment, clearly it does look cheap. It's a company with numerous issues over the past in terms of capital allocation, execution, and the like. So I think there are some good reasons why the stock has derated and clearly out of favor at the moment. So I think, for me, a lot is priced in here. I think I'd be cautious in terms of sizing the position, but certainly in a scenario where oil prices do go higher, the stock is extremely geared to that outcome, and you could get quite a lot of upside. But like I say, it's not without risk in terms of the investment case, given the debt on the balance sheet, given some of the long-tailed liabilities as well in terms of rehabilitation and the like that you just have to be careful of. And then just cautious on capital allocation and strategy and execution from the management team as well.
Grant, I think you've spoken about Sasol, and from what I can remember, you're a little bit cautious, aren't you?
I am. I am. I don't think it's particularly efficient or good management in what they've done with the company. I think the only business case you can make for owning the stock is that it's cheap. And if you think there's other factors, the macro factors are going to take it higher. So you think oil prices or chemical prices are going to move in their favor. There's nothing they are doing to suggest that it's a great opportunity because it's cheap. So that's as a starting point is not a great footing, unless you have a strong view on that perspective. So no, it's not a stock I love. It's not a stock I would rush to own it, even at these levels, without a strong view on the oil price.
Yeah. All right. Let's go into Anglo American. The viewer says I'm 30% up. Should I take a profit now? It still has a 7 Rand per share dividend in it. Yeah, do I sell out or do I hold for better days? Jared?
I still, obviously Anglo American's been subject of an offer from BHP and lots of speculation about whether additional bidders will come into the play or whether BHP itself will raise the price. So there's a lot going on at the moment that is uncertain. What I would say is, clearly the offer that's come through has alerted the market to the implied pricing for the non-listed assets within the business, and particularly for the copper assets, which are in high demand at the moment. So clearly, depending on what your view is on copper and the sustainability of the strong price rises that we've seen, certainly that looks like an attractive space in terms of where technology and production is going. And if that is sustained, you can understand why it's in high demand. So, I think, if you apply a reasonable multiple to this asset based on other transactions and how attractive the space is at the moment, you certainly can see why it would be attractive for another bidder to come in or BHP raise the price itself. Clearly there are synergies involved. If someone like Glencore comes into the mix, that could justify a higher price as well. So, for me, I still think there's upside in holding the stock.
All right. There's a very interesting question on a capital gains tax here, referring to transaction capital and We Buy Cars. Regarding transaction capital spinning out We Buy Cars, where does the capital gains tax come in, as we have a loss at transaction capital, but given shares into We Buy Cars, from what price criteria was used? Because the initial bundling was at a NAV of transaction capital. So if I should sell We Buy Cars, what then? Very technical for me. Grant, care to help?
So I will not profess to be a tax expert. It's been a long time since I studied tax, but I think based on what we were saying earlier with yourself and Jared, I think you'll find there's a base cost adjustment to the two assets. And We Buy Cars will have its own base cost, transaction capital, its own base cost, and your CGT will be determined with reference to that. Your base cost of We Buy Cars is potentially going to be the listing price, but there will be an adjustment because it's pro rata with the shares. So it's complicated. I don't have all the answers, but I don't think you've triggered a tax event on the listing. I think if that's what the viewer is asking, I don't think that's the case.
All right, Jared, anything to add there?
No, I would just add. If the viewer wants details about it, the tax implications will be in the pre-listing statement. The tax implications, how the base cost is apportioned, and some of the details will be disclosed in that document in full. But I'm not familiar with the exact details now.
All right. There's another technical thing, something that I just Googled today and Grant during the break. May you look at the US dollar custodial certificate. Grant, just enlighten us from what you've just Googled.
Okay, so this has been around a long time, and this is news to me as well. Since 2017, it's a JSE listed certificate. It's listed by RMB. You're basically buying the US Treasury bond. You're getting the capital and the interest on that bond in rands. So it's giving you a rand hedge exposure to the US, the US Treasuries. So it has some. I can see the interest. You've got the credit of the US government. You've got the dollar return, in rands. So you've got some rand hedge qualities, and you've got probably the best yield you've had in many years. And on the US, the longer end, I don't know what the maturity on the certificate is, but So if you have a view on long-term rates in the US, I think ordinarily it would be expected to come down, but given the fiscal, the spending and the moment and the way the debt is going in the US, I'm not sure it's fine. It's not a great place. It's not where I'd be putting my money, but I do think it's a better credit risk than the SA government, I would say. So in rands, the rand has depreciated. I'll say last thing, about 7% a year for the past 20 years. So if you're taking 4.5% on the 10-year treasury plus 7%, over time, you can expect a reasonably attractive yield, which is embedded in the rand hedge component. So not a bad, interesting little instrument to have a look at.
Very, very interesting. Here's another question on Alibaba. As a South African resident, should I keep my Alibaba ADRs or convert them to shares on the Hong Kong Stock Exchange? Jared?
I think there's a number of factors to consider. So firstly, the investor just has to make sure whether they are able to invest on shares in the Hong Kong Exchange, depending on their broker account and the relationships that are set up. Certainly, if they've got both options, they just need to consider some of the other factors, the trading costs, the custody and the like that might be incurred. The one factor that I would say just to be aware of is there is obviously additional risk when you take ADRs, particularly of the Chinese names, just given the political tension, some of the sanction and tariff risks and the like. And there has been talk, particularly stocks that have been on the sanction list in terms of goods that they've been supplying, possibly being delisted or being banned from US pension investors being able to invest in them. So I think from that element and a technical reason, it's probably a bit safer to be in the Hong Kong listed same name, but obviously it's the same fundamental underlying exposure. But I'd probably, if you ask me between the two, I would take the Hong Kong listed one.
All right. Well, let's get on to the banking sector on the JSE. Will you still have a buy on Nedbank at current levels? I expect the dividend to increase to over 20 Rand a year. Your thoughts, please, Grant?
I think the whole banking sector still looks interesting. Nedbank's one of the cheapest, Nedbank and ABSA, and you're getting a great dividend yield, probably still around 7.5%, and the neighbors. I think it's fairly attractive, and if you see an improving economy, which I think we will see, yes, there'll be some rate cuts which hurts their interest margin, but if you start seeing a pickup in economic activity, easing in the credit loss ratios, I think these banks look interesting, and they're a great way to capture some kind of economic improvement while still being defensive, because you've got a really nice dividend yield and you've got really cheap multiples. So Nedbank's not my pick of the banks, but certainly I think the banks are a space where you can still look for value and invest.
All right. Well, there's a question here on Renergen. Let me look for it. Of course, they did have an announcement earlier on in the week about producing helium. Now that Renergen has produced their first helium, it might still take time to produce the quantities they have promised, but is it time to nibble at the stock at the very low share price and keep it for a couple of years? I assume that the share price will jump once full helium production is reached, or is it still too early, Jared?
I won't profess to be an expert on Renergen or the investment case. What I would say, there are obviously some quite vocal critics on a few social media platforms on the Renergen investment case that are not for 1 second saying that they're entirely right. Clearly, there are, there's bull cases and bear cases on the stock in terms of some of the critics. Any early stage production asset, whether it's a mine or a gas reserve, comes with risks in terms of production and exploration and costs and the like. So there is an element of risk that's embedded. With that comes capital costs and balance sheet risk as well. And I think you just need to be aware of the risk that you are taking, and then also take a long-term view on the commodity that's being mined or the gas reserve that's being exposed, and just take a view on sustainable costs and profit that can be realized when you're doing evaluation and discounting those cash flows to come back. So I don't have a strong view either way on the stock.
Yeah, and really analysts have just been cautious of that exploration risk. And of course, even with this helium, there had been delays on delays on delays. But finally, Grant, do you think that once they have a full helium production, then the share could surge?
Yeah, this is highly speculative. The thing is, it's still largely kind of greenfields. There is some production, but according to Renergen, I think they said their asset value is, well, they've got 7 billion cubic feet of reserves, and it's worth $4 billion. The share's trading at 1.8 or $2 billion market cap. So there's a massive disconnect somewhere. And the market's not stupid. I suspect that there's a bit of an overstatement of that value or what it's going to cost to get it out the ground. And so I think you need to just recognize that it's a highly speculative investment. And if you still want to, have a little punt, take it with a lot of caution and by all means have a go, but just commit
Okay.
very small amounts to it until you have more insight. I don't have any further detail than that, and I don't think it's something I'll be rushing into anytime soon.
All right. Well, there's a question here on Datatec. Let me just find it. Panel's view on Datatec. There was an analyst view on a financial website yesterday that it could double in 6 months. Jared, is this one that is on your radar?
Yes, I think definitely so. The Datatec, I think, is underappreciated in terms of where the valuation is. Probably a stock that's under the radar of a lot of investors, just given its size and liquidity. But it is a stock with strong management alignment in terms of the ownership of the business. And I think it's always a positive to have management on your side. There's also a stated objective to realize value in terms of the assets. We have seen in the past businesses, some of the subdivisions being sold and realized reasonable prices. And I think if you do a sum of the parts valuation, looking at peer multiples and where assets could be realized at, clearly there's a value opportunity to be unlocked. I think the management team there has been particularly good in terms of the way it's handled the process. It's been cautious in terms of the timing and trying to maximize value from the assets that it's got. So probably one you need to be patient of in terms of the story and unlocking the value, but certainly there's a lot more there in my view.
All right. Well, a different question for you, Grant. Shell, Anglo American, yes, BNP Paribas today, and a looming election that is creating a cloud over FDI in SA Inc. The old saying, sell in May and go away, could knock. Is it an entry point for a medium-term hold? I'm not sure. Because I think the question is on Shell, Anglo American, and BNP Paribas. Grant, I think there's a second part of the question, but you can answer that.
No, okay, maybe we should finish the question. Let's hear the rest of it.
There's also SA healthcare stocks are not looking great. NHI risk 2. Is it an entry point for a medium-term hold? Yeah.
Right. So on the sell in May and go away, I don't subscribe to those kind of things. I mean, as a long-term investor, you can't be worrying about is it a good month or a bad month to be investing in the market. Look at the valuations, look at the prospects of the company, and just accumulate. Especially if you're going to hold for medium to long term, you don't worry about what month it is. Look at the underlying what you're buying. That's the first thing.
Yeah.
With regard to hospitals, talking about looking at the underlying, that's a classic example. I don't think the NHI is the problem. Hospitals are struggling because they can't grow their patient days. They can't pass on the pricing. They've got a lot of input cost pressures. They've got staff shortages. And the medical aids are putting the squeeze on them on the other side. So they've got a lot of headwinds in that industry that have nothing to do with NHI. That's just a story to come that adds even more challenges to the sector. So I think they're cheap. I think they probably stay cheap. And it's not a sector I'm excited about.
All right. Well, what are you excited about? Jared, what's your stock pick for today?
My stock pick for today is Prosus. Grant mentioned it earlier in terms of Tencent and the positive prospects, but I think that underlies the investment case. And we do have a very positive view on Tencent. Certainly the valuation looks very reasonable on 13 times forward PE ex associate investments. For us is extremely reasonable relative to mid-teens earnings prospects over the next 3 years at least, given some of the margin opportunities, the additional revenue lines that they can take. Obviously, a large buyback at the 10-cent level and a much increased dividend is positive as well. That feeds through into the Prosus investment case. discount has widened over the last couple of months to the level we think is back to an attractive point. There's a new CEO likely to be appointed, confirmation at least by the end of June. So I think that will remove some uncertainty in the investment case. We should get better guidelines in terms of the strategy going forward and some of the capital allocation prospects. But certainly we expect lower losses from the e-commerce portfolio, the continuation of the buyback, and hopefully crystallizations of some investments to come through to help support sentiment around where the discount is. So process our stock pick.
All right. Well, Grant, let's close it off. Your stock pick for today?
So I'm going with Airbnb. They reported last night a little bit. The market it's had a bit of a pullback, and I think that's a great opportunity. This is a company that's moving into significant operating leverage. As their revenue grows, they've got very little capex required. As we see the Chinese consumer recover, their outbound travel is going to drive some travel growth as well. I think this company is incredibly cash generative, and it's going to get even more so. So it's a very exciting story. I think they've got a long growth runway, high free cash flow business, and I think it's a great opportunity. If we see a decent pullback now, I would hold it for the long term, accepting that there will be cyclicality along the way, but it's a good story that I like.
All right. Well, thank you so much for your time and for your analysis today, gents. Really appreciate it. That is all for tonight's Stock Watch. Thanks to our guests, Grant Nader from Benguela Global Fund Managers and Jared Houston from All Weather Capital. Up next, The Close. Stay with us.
Thank you.